Well, hello, this is Jim Musgrave with Research Financial Strategies, and welcome to my market video for Sunday, February the 11th, 2018. So I'm going to start off right off the bat right here, kind of show you like the long term on what's going on. So this is the S&P 500 on a weekly chart over a 5-year period. And you can see that this is the 200-day moving average, and we've been over the 200-day moving average for a long time, and then boom, I'll just zoom in right here, the last 2 weeks we've just wiped out all the gains that we experienced through November, actually late November, December, and early January. And so with a very short period of time we've wiped out gains, but however, big picture, we are still very, very bullish. This is a short-term pullback. This is not a bear market recession, okay? But just to give you an idea on how extreme these markets are, I'm going to take you to the volatility index. This is the VVIX. This is the volatility of the volatility index. And just to kind of put things in perspective, the last time we saw numbers this high was in August of 2015. I want to show you this right here. I'm going to zoom in. And you can see that back in August of 2015, we had a huge spike in the VIX and then a pretty quick decline, and things kind of calmed down a little bit. But you know what? If we kind of zoom out and go back to where we are today, you can see that we had a huge spike, but the volatility has remained up here. So what this is telling me is that we may have more volatility moving forward in the next short period of time. Now, again, and another thing I was going to, actually, I'll just show it to you right now. There's an article that I posted on my Facebook page, the SOFA Facebook page, that these guys from Goldman Sachs did some research, and you can see that corrections, the average was -13, and it took on average 4 months to recover. That's the average. And so if you look right here, they start right here back in 1946, and then they kind of going down to the most recent one in February 2016. And you know, again, there's some times when it'll be a longer recovery, but on average it's about 4 months. So again, the world economy is very strong, and I'll just kind of share with you some of the reasons why I say that. So let me just kind of take you to this real quick. So again, very bullish on the S&P 500. Again, if you've been in cash since March 9th, 2009, you missed out on a 295% rate of return. So being in cash for a long time is not the way to go. So you can see, though, this has been one of the longer bull markets that we've had, probably the second to third longest in history. So statistically speaking, we're closer to a recession than not. However, you know, we have no indication of a recession in the near term at all. So, but this just kind of puts things into perspective in terms of the length of the bull markets that we've had. And again, positive economic indicators. The U.S. Conference Board leading economic indicator, again, we're positive right there. Small business optimism index is positive. The CEO confidence is high. The consumer confidence is high. And you can see that unemployment has dropped from 10% down to about 4.1. That remains to be the unemployment figures, today. And this is a first time since 2010 since major economies across the globe are in sync. So this is what these green squares mean, is that there are positive quarter-over-quarter growth. And the last time we've seen U.S., China, Japan, Germany, U.K., France, India, Italy, Brazil, and Canada all in positive growth was back in the third quarter of 2010. So this is actually a very positive sign, okay? Now, you can see here with the Eurozone growth that GDP is going up, which is very good. Unemployment is going down. Credit demand is good. And we can also see that the U.S. markets have outperformed the international markets since 2009. However, in the last year or so, or a little bit more, the international markets are starting to outperform U.S. And if you look at the PE ratios, you can see that U.S. is 18 times moving forward earnings, and and everybody else minus the United States is about 14. So really what that means in English is that the rest of the world has more room to grow than the U.S. at this point, which sounds good. So in our aggressive portfolio, our aggressive growth portfolio, we have roughly a third of the portfolio in a very well diversified international, different sectors. And so that's definitely, you definitely want to have exposure to international in your portfolio. Okay? And also this is just another slide that kind of shows you that you can see Europe right about on the 25-year average. Japan is far below average in terms of the valuations. They have a long way to go in terms of upside growth, and also emerging markets is right there as well. So anyway, we see some good growth opportunities in terms of the global earnings, Japan, emerging markets, and Europe. Good sign. And one of the reasons why we've had these the markets do so well is that we have been addicted to debt and low interest rates, and this is a beautiful chart that explains that. You can see that the Fed started, I guess, in buying bonds, or what would they call the quantitative easing. They lowered interest rates, started buying bonds to kind of basically stimulate the economy, and they've kind of started to unwind the balance sheet at this point. And one of the reasons why the Fed is selling bonds is to get these bonds off the balance sheet, also to get the rates to a more normalized level. Because again, we know another bear market recession will come. We just don't know when. And if we have very, very low, historically low interest rates, then the Fed doesn't have many tools to stimulate the economy at that point. So, one good thing that Janet Yellen has done in her tenure, again, which just ended very recently, but she's done a great job in making sure that the Fed doesn't raise interest rates too quickly. So it's been a nice, slow, even slope. And again, I'm making a projection and assumption, but I think the new Fed chair should do the same thing. So I just don't see interest rates just shooting up, very quickly and multiple times this year. My hunch is that the rates will continue to have a slow rise, over time. So that's good. But with that being said, rising interest rates is one of the biggest risks to both the stock and the bond markets. Probably more close to the bond markets. That's where the risks are because of the Fed doing that. Now, just to kind of give you another illustration of this, the yield curve has gotten very flat. And just to kind of put this in English, what it means is that typically the short-term debt has a much lower interest rate, and the longer-term debt has a higher interest rate. But as the yield flattens, it's harder to get more return when you go out the yield curve right here. So what you have to do in your portfolios is that you need to have very short duration positions in your fixed income portfolios. Have, again, short duration, floating rates, possibly some convertible bonds, things that tend to do well in a rising interest rate markets. And one thing I just want to kind of point out to you is, a 1% rise in interest rates can cause lots of havoc. And you can see the further you go out on the yield curve, the more at risk you are for losing money. Just as simple as that. So if you have a 10 or 30-year U.S. Treasury, a 1% rise in interest rates can drop that to very uncomfortable numbers, as you can see right there. However, in these sorts of periods, convertible bonds, floating rate bonds, U.S. high yield can be good places to be. So that's something that if you're going to take a tactical approach, those would be the areas that I would focus on in the fixed income portfolio. So, and again, this is the Barclays U.S. aggregate, which is basically is made up of multiple different asset classes within the bond sectors, and the average duration is about 6 years. And that's one reason why the AGG has dropped. Year to date, it's down 2.35%. And I'm going to show you a chart in just a second. But again, you guys really need to be careful about the fixed income. The bond bull market is over, and now we are transitioning to some very, very difficult, volatile times in the fixed income. So if you don't like that, then you've got to really be tactical. You really need to know what you own, especially in your 401ks and your retirement plans. They're not typically managed by somebody. So again, that's my concern about the bonds. And just to kind of wrap things up, the world is in sync. This growth is real. High consumption, higher trade, rising GDP. We have pro-growth policies. Lower taxes, low unemployment, reduced regulation, good earnings have contributed to positive growth and historically low volatility up until the last couple weeks. So again, overall, we're in really, really good shape. When we transition from, not so good times to a very, strong period in the economy, and when Fed raises interest rates, again, there's going to be some choppy waters, and we know that. This is healthy. This is normal. We've seen this movie before. So again, overall things are good. We're just dealing with short-term volatility. One thing that has not happened, which has been positive, is that the central bank, the rates have not risen. The rates have risen without disrupting the markets so much. We've had relatively low inflation. Now that inflation is going to start picking up a bit, but overall, inflation is at a very reasonable level at this point. There's been no major interruptions to international trade, and there's been no geopolitical shock yet. Again, there's always a chance of that. So we'll see what happens, and hopefully the geopolitical shock won't happen, but you never know. Again, as the economy improves and interest rates rise, there'll be more volatility, especially in fixed income. I just went over that. And the Federal Reserve is selling bonds to get them off the balance sheet. Just went over that. Unwinding of the balance sheet and interest rates are putting downward pressure on bonds, especially bonds with long durations. So you definitely want to be in short durations. Fixed income portfolios should be overweight short duration bonds to minimize interest rate risk. You got to do that. You got to understand what you own in your portfolios. So the areas that you want to focus on: floating rate, convertibles, foreign bonds, emerging markets, high yield bonds. They will most likely be the asset classes that will outperform the medium to long duration U.S. Treasuries and corporate bonds in 2018. In terms of the risks that we see, will there continue to be pro-growth policies? We'll see. The chances are there will, but again, that's been one of the big things that have stimulated the markets the last year. Geopolitics matter. Again, watching the Olympics, we've kind of seen a little bit of cooperation between North and South Korea. That's a very positive sign. At least they're talking to each other. There's always some things going on in the Middle East that are always of concern. But so geopolitics are certainly an area that could add risk to the markets. What happens when four central banks start to normalize at the same time? That rarely happens. So if the United States starts to raise interest rates, what happens to the ECB and Japan and these other countries? That remains to be seen. We're kind of in a sort of uncharted waters here with global monetary policy. Market accidents. There can be less liquidity than people expect in downturns. Especially there's a lot of inverse and leveraged ETFs and just interesting stuff that are out there. And there are margin calls, and there are options and puts, and there's lots of different things that people are trying to use to deal with risks in very, very choppy, volatile markets. And sometimes that adds it actually adds to the problem, and then actually leads to less liquidity. So that could be a risk that's out there. Complacency. I see that. Things have been going so smoothly for so long, the last little over a year, that people just don't make any changes. But this pullback that's happened is good because it wakes people up, and that very anxious feeling that you feel, you need to remember this feeling, because this can and will happen again. And so, especially in retirement, when you need to take less risk than you should when you're in your younger age. This is a big deal. So again, one of the things that you can do with that, in combination of good professionally managed money, is annuities. Again, fixed, equity index, variable, something with a living benefit on it. These are all good things that can guarantee an income stream that you can't outlive and minimize volatility. So complacency is a big deal, and the time to make adjustments is before you lose the 10, 15, or 20, or even 50% of your portfolio. Okay, a lot of people just don't do that, and they'll just wait it out. Oh, come back, it'll come back, it'll come back. Again, with us, we have a threshold of roughly -13 and -14. Once we kind of reach that and go beyond that, then we really start to get defensive. But at this point, again, we made a conscious decision not to sell, because again, the overall global economy is doing so well. Okay, so just be careful about that stuff. And finally, rising healthcare costs and assisted living expenses is one area that we rarely talk about. Nobody wants to talk about it, but it's one of the areas that can completely destroy your portfolio and affect your life, your lifestyle for you and your family. So one of the things that you need to really think about and consider seriously is long-term care insurance. I've been doing a lot of research on hybrid policies, hybrid life insurance with long-term care benefits, and hybrid annuities with long-term care riders. So if you have any questions about that stuff, please give me a call, send me an email, because you need to know about this stuff. We just did a big project where we called assisted living and continuing care retirement communities across Maryland, D.C., and Virginia, and prices start around $5,000, go up to about $13,000 a month per person for this type of care. Really expensive. So that's something that you need to take seriously, and if you want to discuss it, get some more information, or have me run an illustration for you, let me know. Be happy to do it. Okay, so just kind of recapping things. This is what is going on in the bond markets. These are all the no transaction fee bond ETFs that we have at Schwab. Only a handful of them are actually in positive territory for a year. What we want to see is all green dots. Each one of these columns is a moving average. We've got the 10, 20, 30, 50, 100, and 200. In a good market, we see all green dots. But you know what? We're not in a good bond market right now, and I'm seeing a sea of red. It just doesn't get much worse. So this is the AGG, my bond benchmark. You can see this is the chart. It just keeps on going down, 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 because interest rates are going up, 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 and we're down 2.35%. So again, I'm going to say it over and over and over again. You need to know what you own in your fixed income portfolio, especially in your retirement plans. Again, stick with shorter durations until things start to stabilize a little bit. Overall, the stock market, I'll just kind of get up the SPX. I just kind of showed it to you before. This is the 50-day moving average. Here we are in 2017 and a little bit in 2016. And we've had a nice run, a huge melt up in January of this year, and then a whoomp. Just the air let out of the balloon. But again, we're starting to see signs that things are starting to turn around. If I zoom in, this chart right here has a long wick on the bottom, which means that the chances are that the market's going to, again, we're trying to find some support, trying to find a bottom right here. So by the time you see this video, another few days may go by, but the point is that the indications that we have is that the market may have found the bottom. If it hasn't found the bottom, it may find it very soon. But anyway, that's a bit of the S&P. Again, be diversified in your portfolios. Keep an eye on it. If you have any questions, give me a call. Again, you can give me a call, 301-588-0514. You can visit my email. You can visit my website, jimmusgrave.com. You can get in touch with me there. You can also go to my Speaking and Workshops tab, and you can see that I'm doing about 2 seminars a month. And I kind of rotate between Rockville, Silver Spring, and McLean. mostly on retirement planning and retirement investing. So if you're interested in any of our seminars, please join us. Go to the website. You can sign up right there. And again, I'm going to encourage you to like our SOFA Facebook page. And again, I post lots of great articles on there weekly, and I highly encourage you to do that. So until the next time, this is Jim Musgrave. I hope this has been informative and helpful. But again, everything's going to be okay. Take a deep breath, and we will see you next time on the market update. All right, until then, we will talk to you later. Okay, bye now.